Good afternoon, everyone. Our webinar will begin shortly. Okay, good afternoon, everyone, and welcome to Security Bank Trust and Asset Management's webinar entitled Almost on Solid Ground Markets at a Critical Juncture. Very interesting title for a webinar today. I'm Dani Laurel. I'll be your moderator for today's discussion. Now, today we will be tackling the major market events that happened during the first half or year to date of 2022. And this will be including our experts' views on the economic recovery as well as what we all know as the tenuous path ahead given all of these uncertainties. Now, to better understand all of these market events and give us an update on the economic outlook, joining me here today, we have with us Security Bank's Chief Economist, Dan Roses. Hi, Dan. We have with us also, of course, Security Bank's Chief Investment Officer, Sir Noel Reyes.
Hello.
And the Head of Fixed Income, Dino Aquino.
Good afternoon.
And finally, we also have the Head of Equities, Basil Go. So good afternoon, our distinguished speakers. I am very, very excited because this is going to be quite an incisive discussion, I'm sure. So please feel free to just jump in, give your opinions. I know they're all boiling in your head, especially after the day that we've had today. And I'm sure that our audience here are very well equipped, are very well informed, and have quite a lot of insights that they would like to have from this discussion. So let's make use of this 1.5 hours very well and trying to really digest all of these issues that are going on. All right, now we know that it's been a big day today. The BSP fired off-cycle hike, on the back of course, the highest inflation print in 4 decades in the US. But before we get to that, I want us to all take a step back, okay, for our audience here, and just think first of how the domestic market has performed year to date. So let's kick off with that. How are we doing? Okay? Are we on the path to recovery? This is almost solid ground title. Are we really almost on solid ground? Let's kick off with Dan. Give us a general overview of how the Philippines has performed year to date in 2022.
Year to date was a roller coaster. To put it lightly, beginning of the year we were really optimistic about the outcome, and then Russia-Ukraine war was a black swan event. Nobody really expected it to exacerbate global inflation that much. So that was essentially by the start of the second half. That was the main driver already. So we're seeing inflation. We're seeing central banks react to it. So that's why markets have been moving because of that. Exchanges have been moving. We're seeing commodities essentially creeping into households already because households are feeling the pinch. Producers are also beginning to complain about it because the cost to produce have gone up. So essentially it was contrasting. Beginning of the year, like I said, all the indicators were in the green. And then after the war, that exacerbated some some post-pandemic recovery. So essentially, that's where we are right now.
Okay, we'll nuance that a little bit later on, Dan. But just to open with this fact that it's been quite a roller coaster ride. A lot of the gains that we saw in the first part have now it's anybody's guess where this is going to go. But Noel, what about the investment climate year to date? Are people still looking at fundamentals here, or has there been much more edginess?
Well, let me repeat what Dad said. No, he said we were positive at the start of the year, and that was true because we were coming off from the pandemic era where GDP growth was still uncertain, and the performance of the country during the first quarter actually gave a concrete signal that we are indeed beyond that. That's why the title is almost on solid ground. It was premised on the strong GDP growth, and it was also the premise or the basis of the BSP for trying to sustain a lower rate hike, a gradual rate hike trend, no, for the year. But of course, the war happened and everything else went crazy and created havoc on the markets. No? So now, all asset classes, equities and fixed income are in the red. No, yields are higher. Equity returns are in double-digit negative. But the investment client currently is on a wait and see and are pretty much liquid. So I think they will be on the prowl, no, and will look for returns and yields on markets that can provide these. The outlook we have is that probably in this third quarter we can see inflation peak, and when that happens, then we can probably see a positive tone in both markets. No, fixed income first, and then followed by equity.
Okay, thank you for that. Now, what about you, Dino? Let's talk about the fixed income climate year to date with all of these, so to speak, unexpected rate hikes that we've been seeing.
Well, on the contrary, it's been one direction. It's not really a roller coaster for the fixed income markets. We started the year on a bearish tone when it comes to the fixed income markets. Of course, it's a normalization, right? So definitely most central banks, including ours, will raise interest rates. So we approached 2022 in a more cautious tone because we do expect interest rates to move higher. We didn't expect it to be this high, and this fast in terms of accelerating the benchmark rates. But of course, given that for example, in the first quarter, actually fixed income was not doing well compared to equities. It was down negative 3% or 3.5%. The benchmark, at least in terms of the benchmark, versus that of the equities, I think they're still up in February, March, diba? Parang it's 7.1, I think. But since then, actually, bonds are actually just down a percent. So it actually performed a lot better, despite the fact that the US has been raising rates like crazy. BSP all of a sudden made a 75 bips rate hike earlier. And then, in fact, the bond markets didn't really react earlier. So it's more of because everyone is bearish starting the year when it comes to bonds. So it's more like they priced in every possible risk that they can face. But of course, there's still a lot, right?
But very interesting to be going back to you later on,
Okay.
on your bets there. Okay, Basil, equities. We did see, of course, still we're not as bad as we had seen in the height of the pandemic. So tell us, has it been in any way resilient compared to other parts of the market?
So in the equity market, as mentioned by Dina, actually the first quarter was quite strong. If you look at the region, ASEAN was in fact up year to date, while other markets like the US were down. Mainly because ASEAN was value and US mainly centered on growth stocks and tech stocks. No, but unfortunately, because of this Black Swan event, the Russia-Ukraine invasion, things started to head south. If you look at tables here, year to date, only Indonesia and Singapore are up year to date on local currency terms. But if you translate everything to dollar, all markets are down year to date, and the Philippines, one of the worst performing currencies, trailing only the yen. No, it's down double digits, I believe 18%. So definitely, this is things are quite sour, but we are still remaining glass half full perspective. We're still quite optimistic in the second half of the year.
Okay, and maybe some opportunities also for bargain hunting or swooping in, hopefully. All right, now let's try and digest all of these specific issues that you guys pointed out. So, of course, the biggest Black Swan event is geopolitical, out of our control, the Russia-Ukraine war. Dan, give us a feel, or our audience a feel here, because there are two camps. No, one saying that inflation is something beyond our control. Another camp saying that we're not as bad as other countries that are much more reliant on the oil of Russia or the energy supply, like Europe, like the US, which are inevitably going to be in a recession. Clarify for us, how big of a threat is this Russia-Ukraine war persisting to our domestic economy?
Well, both camps are right, actually. No, um, yes, we're not that as affected with regards to Russian oil, no? But nevertheless, we still get affected because of um, the macro summation, no? Because with Russian output down, that means the global share of oil is also down. No? So that's what's driving pressure in terms of prices in oil. No? So I think a protracted war would eventually lead to either the markets accepting that elevated prices are here to stay, no, or eventually that's going to force some other output sources. Now, for example, you have OPEC probably opening the tap more, in order to be able to supply that glut. No, but either way, uh, uh, prices will probably remain elevated. No, it's off the highs already. Actually, the overall oil market is in bear territory at the moment. But there's some scope, given all the uncertainties that's still happening, no, that it could go up again. So, so that's something that we have to watch out for, and eventually that will inform the decision of central banks globally, where their rates should be.
Mhm. No, well, maybe you can add to that. When we look at the Russia-Ukraine war and where the money will be flowing because of those events, will there be a flight to safe havens, even if these safe havens are, like you said, more affected? Or will there be, shining light on emerging markets, for example, which might be a little more insulated?
Well, to be honest, no, foreign flows have been dismal. I think not only for the Philippines, but I guess for the rest of ASEAN. No. We had a view that ASEAN would try and outperform the other developed markets, given the fact that they are seen to experience recession, no, both in Europe and the US. Now, in terms of haven, of course, the haven would likely be limiting yourself to which is strongest, which is the dollar, still at this point. No, so that's going to fly, and by virtue of that point, and for experience, it's always the U.S. Treasuries that are being resorted to in times of crisis. Locally, people will had resorted to being shorter on the exposure, referring to money market funds and time deposits, no, but while waiting for the opportunities to come back, both on the long-term fixed income government securities or bonds and equities markets. So for me, the haven will be dependent, and locally it's on the shorter end, and internationally it's still going to be the US dollar.
And given that, what opportunities are there in equities? Or is there sectoral, bias? I mean, we did see the mining and oil counter going against the trend, so to speak. I mean, sadly, there are still some sectors that have benefited from this war, renewable energies, etc. So have those been performing or outperforming? And will this be sustainable, or is this something that, is directly linked?
So if you look at stocks that performed well so far year to date, no, definitely with the Russian invasion of Ukraine, the need for energy is at the forefront, no, it's in the forefront. If you look at the prices of commodities such as coal, oil, and nat gas, no, they're still up year to date, showing relative strength versus other commodities. Now, if you look at agricultural commodities, some metals, they're already down year to date. So the need for energy, especially with the heavy dependence of Europe for Russian oil and nat gas, you see the need for these energy now. Of course, in turn, we cannot depend on these, you could say, old, dirty energy sources now. So that begs the question: where do we get these sources of energy? That would be renewable. The need for renewable comes to the forefront because, in theory, if there's unlimited supply for the sun, wind, and solar, no, the variable cost for these energy sources are basically zero. So when you have these high commodity prices, that increases the need for these other renewable sources of energy.
Okay, and we'll be going back to those investment plays later on, and whether they're overbought na ba, or how much farther can they go. Okay, now on to the topic of the day, which is, of course, inflation vis-a-vis interest rates. Before we get to the inflation here in the country reacts on the 75 basis point off-cycle rate hike today. Dan, was that in any way expected? We wish we had expected that. Or in any way a relief, like good that that actually happened. Go ahead.
Well, I would say it was warranted at this point in time. It was very warranted because, yeah, I think the bigger catalyst was actually the inflation numbers from the US. No, so
Yeah.
so that was a very big variable in terms of the decision point, probably from the MB, and doing a bazooka off cycle rate hike at that. No, so that came after the report from the US, which printed at 9.1. I think that's the highest since 2000. 2000, but that was
1982,
40 years.
40 years. Yeah, sorry. Yeah.
my age.
So 40 years.
Older pala. So,
It's quite high. No? So that necessitates probably a bigger hike from the US Fed themselves. So that means no, probably will fall way behind the curve if we don't act now. And they did. So yeah, it's really warranted at this point.
Okay, go ahead.
Yeah, I think the market actually today, we are expecting the markets to be really moving negatively, right? But so far, prior to and starting our talk today, the markets are pretty much even from the previous close. So I guess the action that the BSP has done actually is treated well by the investor community.
Okay, Dino, go ahead. Your reaction to that, especially since you're looking at the spread narrowing now. How does that bode well for the fixed income investments?
well, for me, as Dan mentioned, it's no coincidence that they raised today. Coming out of the event, the data that came out of the US, I think when you look at the yield curve right now, it's still not as flat. Actually, the US is inverted right now. It's really inverted. Our yield curve is a little bit flatter compared to that of last year and the previous years, but it's still not flat. So if you look at the short-term rate, like they raised today, right? Though they're looking at a guidance of 3.5. But if you look at where the market is right now, I think the market is expecting a policy rate of up to 4%. Because your 3-year paper is 5%. So I guess like I mentioned earlier, it's pretty much priced in already. Bond traders are looking at the prospects.
Philippines, you
In the
mean
Philippines,
4% by year end.
4%. Diba? They're looking at 4%, even though the BSP communicated 3.5 prior. But given the move today, obviously they'll have to do more, right? So currently, the secondary market in terms of the bond rates are looking at about 4%. So it's not much of a surprise for the bonds itself.
Go ahead.
I guess the new house call of Dan as well, no? It at least places us with a slight premium, even if the Fed raises, no, by year end, so we can still have that premium over the Fed on the policy rate.
Okay, but BSP Gov Medalla mentioned that if he raises rates or if they raise rates more than the 25 bips or even 50 bips, he said something like, it means that we know something that the market doesn't know, diba? What is it that they know now that we didn't know before, that warranted such action that he was really, really hesitant to take?
Well, I think it has something more to do with the exchange. Eventually, that's going to eat up into the inflation narrative. So eventually, if the peso depreciates by as much, or if it breaks the record low, so that will eventually put so much pressure into the imports that we have, because we're very import dependent on oil and food as well. So if that goes south, the fight to control inflation will be very difficult for the BSP. So probably that's what they're seeing right now, and the models will show that as well. That forward-looking expectations, given that the exchange might be depreciating to around 57, will be very bad indeed towards the ability to import stuff. So that will probably spiral into something else. So that's why that move towards nudging the markets to and signaling that they're very, very serious about the fight towards inflation.
Okay, so do you believe that it was a move to stabilize the peso and that it's actually the depreciation is now at a worrying point?
Well, I think it was also a function, first and foremost, really making sure that what happened in terms of inflation in the U.S. does not happen here. Yeah. And second, of course, it's also, as what Dan said, to address the exchange rate, because of course, the second round effect of the exchange rate will also come in, and that's something to stop. Remember, the high point of the peso's depreciation was in 2005, which was about 56.40. We're there, basically, right? So it's something that they probably don't want to happen. That's why they had to do what they had to do.
Does it mean also that they have higher than expected inflation expectations moving forward after the US print? Or is that not something that they've seen based on the data that we have?
They might be fearing that. That's why they instituted that rate hike that aggressively. I guess no, they might be. They might have information that's already in advance, because probably if I'm there, I would already ask around all my agencies of how much our prices are, right? So probably they have that information already. That's why.
Well, our audience is going to ask you here, is that 9.1% the peak in the US? All of you to answer. Basil, maybe you want to go.
Based on the end of this year. And the Fed actually we start cutting rates as early as next. But I guess I'll hand it.
Go ahead. Noel, 9.1% of June for the US. Is that the peak as was predicted? Just
Yeah,
few days ago.
there's a good chance we're near the high, if it's not the high, because we still have to see how July will be for them, in the same way that we have to see July for us. Our call was that the third quarter will be the peak of inflation for both them and us. So when that happens, that's why it's going to be the catalyst for a positive recovery in both asset class markets. No, but of course to different magnitude, because fixed income would probably rally faster ahead than equities markets. So.
Okay, Dino.
I hope so, actually. I mean, if you look at the print yesterday, if you look at how it's computed, there was a report that actually it's the shelter that's the biggest contributor to inflation. I've been kind of obsessed with the U.S. inflation since last year. I'll expound later. If you look at rent, I think in Florida, Miami, I think it's about 30% higher, 40% higher on a year to date, and some other states in the U.S. are showing the same. So it's not really oil; it's really the supply shock and of course shelter. So, yeah, I hope so. I really hope so. Yeah. Because there's an impending housing crisis, yeah, that's going on, and it's
It's not even related to the
it's not even
consumption
related. It's not
story.
totally a different story altogether, right?
Okay. All right, Dan, go ahead.
Well, adding to what Noel said, no, we hope so as well. No, that's the peak. Because like I think 2 or 3 months ago, everybody was in that. Even the Fed said that that was the peak. No, and then what we're seeing in the data right now is that inflation has already crept into the services category, which is much stickier. That's quite difficult to control, no, in terms of monetary policy. So that's giving wage-induced inflation a boost already. So that if that remains sticky, probably we'll see another jump next month, or probably parity in terms of the inflation reading year on year. Because it will react with a lag. Meaning whatever the Fed does right now, it would probably take around 1 or 2 months before that reacts to the monetary policy action. So yeah, I think there's still some scope, but given it's very high already, probably yeah.
Are you looking at indicators to see whether the second round effects have been arrested? And the inflation expectation on those second round effects might be arrested already by this preemptive rate hike?
Well, that would be the core CPI. that's where it's coming from actually. That the inflation pressure in the US is coming from the core. Like I mentioned earlier, it's the services category that's already driving inflation up. No? So if that goes down, no, probably the headline will go down with it as well. No, the other
Here,
side-
Dan, here.
here, sorry, yeah, here it's also the core inflation. We're seeing already some spillover beginning. We're seeing it in restaurants already. Then you have alcoholic and beverages basket. You have education basket. You have the services side, and you have the household furnishings. It's already getting costly, and clothing as well. No, so that's telling us that the producers are already the supply side is already feeding the cost to produce goods already.
And the push for wage hikes
Yes.
will be there. Okay, so generally hoping for the third quarter to be the peak of inflation, both offshore and perhaps onshore. On that note, question on how the market reacted to that hike of the Bangko Sentral.
Actually, when the news came out, no, definitely the market sold off. You see property names really sold heavily because definitely higher interest rates lead to higher mortgage rates, which is definitely that negative for property names. But if you look at the market close today, actually the market closed flattish. So, and if you look at the names that did well in the close were banks basically. So definitely, which I'll elaborate later, is banks will benefit from higher interest rates. Higher interest rates lead to higher net interest margins. So that will be good for the bank's bottom line.
But what about the foreign investors? Would they be coming back in because of a higher or lower spread or narrower spread compared to US equities? Or sorry, fixed income.
Definitely foreign investors would like to see the Banco Central on the ball. No, they don't want the BSP to be behind the curve. This is showing the market that they're arresting inflation problem, arresting the depreciation of the currency. You know, so the foreign investors their PNL is they convert their PNL to dollars. So they want the peso to be strong so that when you translate it to dollars, their bottom lines will be better. No, so this is definitely a good signal for foreign investors.
Okay, bond market, Tino. You said it didn't move.
Well, it moved so much since last year, so been battered so much. Well, yeah, today the reaction was quite muted, to be honest. Of course, there was initial selling, but it was met with a lot of buyers. Because relatively rates in terms of absolute terms are quite attractive. Your 10 years is at 7%, which is, if you look at your 10-year US, it's below 3% right now, right? So the spread wise, it's quite attractive already. That's why I think the market digested it very well.
Okay, interesting. Now, question that it's a bit difficult now, which I had before yesterday. What level of an interest rate hike would markets or investors be happy with at this point? Because some were saying, we needed to get on the curve, and now we're at 75 bips, and then the US might go 100 bips to the end. Are we happy with this 4%? By the end of the year, is that what's going to be the catalyst to bring investments back here, Noel?
The Fed still targeting about also between 3.5% to 4% by year end. Likely we're going to end the same level, given that we're at 3.25 now, and for the BSP to also be on the curve, they have to probably be ready with another 50 and then max and top it to the 25 by year end. That being said, I would think that the move by the BSP today, it's why we've seen the equities and the bond markets somehow kind of just shrug it off a bit, is because at least they were happy. Oh, finally the BSP is done and it's trying to be ahead of the curve. Because that was a question in everyone's minds prior, right? And it was being substantiated by, of course, sustainability of the growth factor to ensure that the GDP grows, bring down your debt to GDP ratio, and provide jobs to people. So at least on that note, he is addressing also the inflation factor that could derail that GDP growth.
Okay, so it's a bit of a calming move, no? Rather than something that's enticing, but at least people are less anxious right now. Okay, let's take a step back and talk about the global situation now. It's no longer necessarily the pandemic issue. Maybe in the Philippines, it's still a pandemic-induced recovery, but a lot has to do with the inversion of the yield curve in the US and just a looming global recession. How bad is it going to be? And can you compare this to any other recession that we've had prior? Dan?
Any recession is brand new. So that's what we've been seeing throughout economic history. No? So, well, obviously it's going to be different this time now because we're coming off of a pandemic. No? There's still that pandemic factor because the slowdown is getting affected by China. So the ports there are the ones giving out the difficulties in terms of the supply chain, which in turn exacerbates inflation. No? So there's still that pandemic factor, and then there's that war. No? So the global recession now will be very different in that the factors are twofold. And on the other hand, at least the Philippines is still projected to grow better than our ASEAN neighbors. So we're not going to get affected by it by as much. Of course, there will be some net effects to it. But we're not as export dependent as other countries. No, we have very good OFW remittance levels, which should help prop up consumption as well. Despite the fact that there's a very high inflation on the horizon. So I think it's going to affect us differently than the past recessions because this time we're not really moving with the herd, so to speak. Because there are, well, for one, we have very good fundamentals in terms of the economy. So we have that going for us. Second is, so we're seeing the BSP already do some very aggressive action. So that could probably be supportive of our growth.
If I may add, if you want to compare the crisis in the past with the crisis now, I would like to reiterate what Dan said, that the fundamentals we have now is quite different from how we were during the GFC or during the Asian financial crisis. The same way, the global environment was also.
Do you mean that we're better than before?
Yes, in terms of economic.
Despite the pandemic, notwithstanding.
Yes, despite, yeah. During the GFC or in the Asian financial crisis in the GFC, the world was highly leveraged. It was a debt problem issue globally. Now, leverage ratios are not that high. Way back then, they were about 20 times from what we are now. So it's not there. So the kind of impact that the former crisis will have is not going to be the same. If there will be a recession that could happen in the countries, it could probably be short-lived. That's why the confidence still of the Fed themselves and other central banks in Europe for raising rates strongly.
Kaya pa.
Yeah.
Kaya pa. Okay.
Yeah, I'll add something lang, Danny. Actually, if you're a bond investor, as bad as it may sound, you actually are going to be excited with the idea of recession. I mean, if financial assets were a music genre, equities would probably be pop, FX would be hip hop and R&B, bonds would be emo, like. Right. So it loves misery in such a way that, for example, in 2020, right, when the pandemic hit, all bond investors were extremely happy, right? Because they think if you see misery like this, like recession, eventually they have to cut rates. They have to stimulate the economy. And the first one that benefits from it is actually the bond market, right? Because the equity market will eventually rally, but it has to wait for more data that come out, more growth, right? But the bond markets will rally right away. For example, if they are done tightening and then recession is a story, and then all of a sudden they cut rates next year, the bond market will be the first to benefit on that.
Basil, what about the equity market? No, but in a sense, apart from the sentiment-driven issue, you do still have fundamentals. I mean, there's still growth in hopefully corporate earnings that we might be seeing. Diba? What's your expectation on the growth of corporate earnings and how that is going to translate into the levels, not just of the index, but of the bourse that we're seeing, notwithstanding all of these jitters?
To address the question of whether higher rates, definitely, firstly, if you higher rates are definitely not initially are not too positive for equity markets. No, there's an inverse relationship. No, higher interest rates lead to lower equity prices because analysts use the discount rate, which discounted cash flows, so discount to the present value. Market prices are lower, but definitely that's a bitter pill you initially swallow, but eventually valuations become attractive and definitely economy recovers. On earnings, based on our projections, now we believe that corporates would be able to achieve earnings that will surpass 2019 levels by next year.
Okay.
But some corporates will already achieve earnings that will surpass pre-pandemic levels by the end of this year. So
Can you clarify why that is? With all of what's going on and higher inflation and theoretically people not having enough to spend, unemployment above 6%, why can corporates still have higher than pre-pandemic earnings?
Well, at the end of the day, there's still the Philippines is still a consumption-driven economy, 70% driven by consumption. If you just go outside, go to the malls, it's extremely packed. Yeah,
Parang walang recession.
And traffic.
And traffic.
traffic, no. Even in if you go, especially on a weekend, no, foot traffic for malls already surpassing pre-pandemic levels. And if you think about it, people weren't going out for basically 2 years now. So there's basically revenge spending. And if you look at what happened to the US, we're just in the initial innings in the Philippines now. People are traveling. If you look at flights are booked, are packed, airplanes. There's just a lot of pent-up demand. So we think that of course, not all sectors will recover simultaneously. Some sectors will recover faster than others. But we have a glass half full. We think that this pent-up demand will continue, and eventually will surpass 2019 levels.
If I may add, you can actually also see that if you take note of automotive car sales, they're also on the uptrend, and that's discretionary spending, which in fact, despite the high prices of gas and fuel, the queue on buying new cars is there. And we add to the fact that the pent-up demand is also the one fueling as well, as fueled rather by the virtue of the fact they probably have saved quite a lot during the pandemic because everyone was at home, and those that really a lot of people were able to save. Savings levels went up during the pandemic, right? So that's now they're trying to enjoy what they've saved and spend it a bit, given this scenario now.
Okay, so there is a lot of liquidity that is there untapped that we're just waiting for the right opportunity. Speaking of that, Dino, are longer dated tenors favorable now given this situation? Because it was mentioned earlier that a safe haven might actually be the short term, but you're saying that if you look at the returns, it's still worthwhile to wait a bit.
Well, we started the year on a bear flattening tone. We actually are very bearish, especially on the short end, and we at that time we were not really buying then. We prefer the long ends more than the short end. In a typical rate hike scenario, it's really the short end that gets hit the first, right? And of course, given that long-term tenors now are yielding close to 7%, if you think about it, inflation's not going to stay 6 to 7% in a year's time, definitely, right? So if you buy a paper, say at 7% now, and inflation drops to around 4 to 5% next year, you're basically holding a paper with a positive carry, right? And you can even sell it if you want, right? So I think at this point, with aggressive rate hikes and faster rate hikes, definitely there will be some compromise on growth, right? And once that happens, the BSP might need to reverse its course faster right? So anything that comes up must come down, right? The faster they raise rates, maybe even faster they cut rates, right? Because if growth is more important, I mean, inflation is, yes, very big concern, but I definitely, given that we're an emerging market, really have to focus on growth. So I think once this inflation story subsides, or at least we can have it controlled if the war ends, cross fingers, if the war ends, eventually we have to stimulate the economy once again.
So that is my next question, because you're saying this is a normalization cycle, right? After pandemic, we need to induce growth, and then now we have inflation. Now we have to what is the normal level? How can you say that we've normalized? Because again, we're hiking rates. Isn't that the normal level for the inflation? And then we'll cut rates next year. So tell us, when does this cycle end? And you say that, okay, we've reached normalization. What is the actual target here?
Well, there's a lot of debate on where the normal level is, no? Given that there's a lot of factors already, no, that will necessitate the definition of normality, no? But siguro for the sake of having a level, probably that's the pre-pandemic 4%, no? So, right now, no. If that's not enough, I'm sure the BSP will provide some scope to probably go beyond 4%, no. And then if they need to cut rates eventually and support growth, like what Dino said, they could probably go near or hover slightly below the 4% area. No? Because right now that seems to be the threshold. No? And of course, that's a function of where inflation will be, no? Because that's going to be necessitated by the value of the real interest rates. So far we're at negative. They want to be at the positive level. We were at the positive level at a 4% policy rate. No? So if we're at a 4% policy rate and the real interest rate is still negative, that's not normal. No? So I think that's still going to be a function of where inflation will lie.
I'd like to add, actually, I'm not a commodity trader, not by any means, but honestly, I don't think commodities prices in general, like oil, they don't know the level yet. I mean, oil surged right in the first quarter because of inflation, and now they're dropping because of recession, and it's all because of the Ukraine and Russia war, which no one expected it to be lasting this long. In fact, when it started, analysts came out with by the invasion, by the fear narrative, because there are historical reference, 9/11, right? Even the Axelrod in billions made his fortune in 9/11, right? So there are historical references. But the difference is right now, I think the biggest question is, when will it end? And how will it end?
Yes.
The worst part is we don't know. So right now, Mr. Putin has the entire Eurozone hostage with his Russian gas, right? And if he loses his mind, then he cuts the supply. That could push the euro below parity, and eventually Europe will accelerate its recession, right? So it's really important that this has to end, because as long as it's ongoing, the market will not have clarity moving forward. The market will not have its equilibrium in terms of where levels should be. Because for example, we're recession fears, but are we in a recession? Or if we are in a recession, how deep is this recession? So where are commodity prices if we are in a deep recession? No one knows at this point. So it's really important for that war to end.
Okay, go ahead, sir.
Yeah, the market normalcy or equilibrium is something that's always chased after by economic managers. No, it's because it's at that state, then the market changes again, then it evolves to a new state. So that's where it goes. If the Russia-Ukraine war, it's really getting prolonged. It's really the main reason behind all of the problems we have globally. You know? And the only resolution of it, as Dino mentioned, is for it to end. And the only resolution given now is either a full take annexation of Ukraine by Russia, or on the other extreme is the removal of Putin from office. No, in between, I guess that's something that's very uncertain of how the allied countries will step in. The economic sanctions is taking a long time to take effect, and it's affecting all of their economies, all of the global economies, right? But the good side of the coin is that at least Europe learned the hard way. So now they're redeveloping other supply sources so that they can be able to no longer depend on Russia. for
Well, as well as in the Philippines,
Right, yeah.
hopefully. But how long will that be taking? Okay, let's move on to the peso. Is there even a normal level of the peso at this stage that you can say is not worrying? That. Okay, just to color that the peso right now has not broken below the 56 despite the 75 bip hike. Diba? What were you even hoping for here?
Well, we were looking at 55 eh. But may record din kami, no? We've revised so much in terms of the levels, no, because of the unprecedented move, no, and the way the peso depreciated was very fast. Especially after, I think that's after the election, so that's when it started moving. So I guess the acceptable level would be if imports aren't as costly. At the same time, that's balancing how valuable or the premium from OFW remittances. No, so I would suppose that's
Are you seeing that? I mean, actually benefiting the. Have you seen that in the remittance print, or are you expecting the remittance print to come in higher because of the peso's weakness?
Yeah, actually, we'll be expecting that in the fourth quarter now. So that could likely offset some of the drag to growth brought on by the policy normalization from the BSP. So that will help support household consumption as well. No, I think the pandemic is estimated that around 15% of household consumptions go directly to, 15% of remittances go directly
To consumption.
to household consumption. Yeah, so that will be supportive, especially fourth quarter. You know, that's the holiday season. Also, that's going to drive some consumption as well. No, so that will bode very well for growth. No, on the other hand, what people will be buying will be more expensive, especially if it's imported, because of that level. So that's why I'm saying there has to be some balance. So the balance could be probably around where it's acceptable.
But this DBCC of 51 to 53, I mean, how far are we from that?
The current level.
Okay.
But I guess that's also something that they're not telling us. Earlier you posted the question, are they seeing something else also that we're not? So probably that's also that level. They want to bring it to that level, probably 53, which is the more acceptable range. Because that affects planning as well. The purchase of government that's sourced in dollars will also be more costly because they will peg it at the 53 maximum. So I guess that's also one of the benefits of the recent move by the BSP. So.
If I may add, looking back after the GFC, OFW remittances and BPO revenues actually helped sustain consumption during that period and help the Philippine economy grow. No, I think that would still be the case for now. And at the same time, the peso at these levels would also be enticing, no? Especially after we reach the peak of inflation and interest rate policy will start to reverse. Then it will also feed on foreign direct investment because then they will be induced by the significant possible appreciation of the peso when everything has cleared out.
Basil, are equity investors really watching every movement of the peso when they're looking, or are they looking at the fundamentals of the companies they're investing in? How does every move of the peso affect the movement of the bourse?
Yeah, definitely. I mentioned earlier, if you're a foreign fund manager, you're earning in dollars, so you want the peso to be at least stable, or I mean, appreciating currency is definitely favorable. But if you look at historical patterns of the peso and the stock market performance now over a long period of time, say 10 years or a 30-year period, there's no strong correlation. But during times of crisis, like the one we have now, or if you look at the Asian financial crisis, the global financial crisis, the 2013 taper tantrum, there is a strong correlation between the FX performance, meaning a weaker currency would lead to a weaker stock market. No? The inverse relationship, so a weaker peso, weaker market, a stronger peso, a strong market. So, but in general, over a long period of time, the currency doesn't really impact. But in terms of corporate earnings, definitely there's some impact there. Some exporters will definitely benefit from a stronger, a weaker currency. But if you're a net importer, import raw materials costs will increase. No, then definitely your margins will be squeezed. No, so it depends on which sectors you're looking at.
I'm gonna press on that. Is there a certain level that foreign investors or foreign funds are looking at on the peso to go back in?
That is a difficult question to answer, but generally, I would say that they want a currency that's stable, it's not depreciating.
Okay.
Right now, it's a one-way street, right? A Asian currencies all of across the board are depreciating now. So a stable currency that's not on one-way street now. That should be something that foreign investors are looking at. Once peso starts stabilizing on certain level or even appreciating, I think foreign investors could come back in a big way.
What about the view that the weakness of the peso is linked to our record high deficit, which might actually bode well for growth if we are importing, or it's capital formation naman. Does that somehow ease the the anxiety?
Well, as long as it supports growth, no, that will eventually rebound to the economy as well. No? So you're right. No? There's that view of the current account deficit going deeper into negative territory. So
Are you okay with that?
well, because we're import dependent, di ba? So that's why imports are costlier, di ba?
Yeah.
That's why it eats up on the GDP growth also.
So eventually it will help GDP growth and consumption as well. It's good if exports are supported by it, no? But so far it's not. And exports haven't been a really good growth driver in the past, 10 years and more. No? Uh, so we have no choice but to be import dependent at the moment. No? So it's costlier. I think it's better if we're at the 50 level from a few years back.
Okay. Any year-end calls for the peso?
Okay, our call is 55 to the dollar. I know it's far from where we are right now, no, but a lot of things that we're expecting will be supportive of that view. One is that very aggressive pivot by our central bank to fight inflation, which eventually will be able to support the peso. And then you have the possibility of a slowdown in the US, which will be dollar negative. So what that means is, that will support the peso levels as well. So that could probably come late third quarter, probably also in the fourth quarter as well. So we think the peso will likely be in that area, 55, 50, thereabouts.
Out of curiosity, no, other ways for the BSP, they did mention they don't want to intervene in the peso, right? But doing this rate hike, of course, directly intervenes. Are there any other ways for them to stabilize the currency?
Oh, I don't think that's really it's not part of the mandate. No, the twin mandates are full employment and then price stability. So it's not necessarily the peso. That's why we're hearing Governor Medalla and NED, the Director General Balisacan, say that they'll let market forces dictate where the levels will be. No, so right now the market forces have forced them into a corner, so to speak. So that's why the need to be able to give off that confidence that they will be able to control inflation. That will eventually benefit the FX. Yeah.
Into a stronger currency.
Yes.
Let's talk about consumption and the recovery story. Basil, where are you seeing the movements in equities? And are those related to consumption stocks? How are those particular stocks performing? Are they better than expected? Worse than expected? Because you did mention anecdotally, it's so hard to imagine that, people are not spending.
Yeah, definitely. If you look at which sectors would definitely benefit, no, I mentioned earlier banks will definitely benefit. No, if you look at the banking sector, the industry has recorded 10 consecutive months of loan growth. No, And if you look at non-performing loans have been declining for 3 consecutive months. And if you look at provisions as well for banks, NPL covers have been going up for consecutive months as well. And definitely, as mentioned earlier, with higher interest rates, that would lead to higher net interest margins and higher bottom lines for banks. And given that the PSPs really looks like they're now more hawkish than before, that should also be beneficial for the banks, no? And given how cheap they are, I think banks would benefit. And I mentioned earlier, mall operators, no, would also benefit from higher consumption. If you just look at traffic, no, tenants are saying that they're already achieving 80 to 90% of pre-COVID revenues, no. So that would result in potentially these small operators, no, lifting rental release, no, for these tenants, because they're now already making money. It's time to stop giving them some concessions, no, because these tenants are already making money, and of course that in turn should be good for the mall operators. And if you look at the basically mall operators are a reopening play, no, more foot traffic, even surpassing pre-COVID levels at certain days.
Of course, the tenants are not going to say that. They're going to say we still need some reprieve. Go ahead.
Yeah, if I may add, no, consumption, of course, current spending, discretionary spending, we're seeing primarily it's coming from the upper middle income to high income levels. Of course, those that really are being affected by inflation are the lower segments of society. And what the government's doing really is trying to continue with their subsidies, no, fuel subsidies for the transport driver, public sector drivers, no, cash assistance, no, to the agricultural farmers and to the least indigent of the community, and free MRT rides and so on and so forth, no, and the like. Now, it is because this segment is the one that's really being affected significantly. And why they want to do that is so that they can continue and be spending on the staples. So I would think that in the consumption sector, if ever there's something that some sector that's going to be resilient, it's going to be the companies, yeah, that cater the basic goods.
Okay, very interesting as well, because the SRPs are still there for the basic goods. But these levels of consumption, or I mean growth, based on fully consumption-driven economy, so 8% levels by next year. Do you see that happening in the first quarter print? Sure, but what about the second and the rest of the year?
GDP growth for the second quarter we have to look at the seasonally adjusted levels. So I think we have a graph here, but it's going to show that the year-on-year reading is actually going to be lower than the 8%. So the reason is because we have a very high base year from last year. Yeah. So that's actually 12% yata, second quarter 2021. So even if the numbers will give off a very nice reading, it's still going to be lower year on year. But we have the seasonally adjusted numbers to look at now to ascertain that we are still on the path to growth. And I think it's going to be better than expected, probably. Okay. Because
so growth nada, not recovery.
Yes,
growth now. Okay.
Yes. So it's growth already, because that's essentially 4 quarters of upward trajectory. So that means we are on that path already. And the looser mobility curves are working. Like what Basil mentioned earlier, footprint in malls is very good. Jam-packed restaurants, and not to mention the traffic, already back to pre-pandemic levels. So that's driving the consumption in the economy. So 75% household consumption. I think we're good to go to say that we are growing and getting out of the recovery label.
And to add to that, of course, the demographics that we have, it's about 25, 26 years old. So that provides for continuity of growth moving forward, because the new, what do you call it, batch after millennials. So
Gen Z.
Gen Z, they're the ones really actually spending a lot also, right? So I think that demand will, the growth rather,
Why is that? Talaga ba?
I think, because my son spends a lot.
Mas
My
magastos.
daughter spend a lot.
Mas magastos millennials
Yeah.
than Gen Z. Millennials spend more than Gen Z.
So that's happening. So I guess they're really focused on trying to maximize their lives, right? So that's why I guess the consumption, if impact, given that we have this demographic age sweet spot of 25 to 26, will continue. So it's just that you have to expand that segment of society that's consuming. So you have to protect the lower segments, as I mentioned earlier.
Is that achievable? 8% next year.
Yes, very. Especially if that the pressure points that we're experiencing right now eventually eases. No, so you have inflation, you have probably a resolution to the war. No, if not, so that yeah, so probably that could nudge growth further. No, and you know there's this consumption drive since the third quarter of 2021. We think it still has more to go, because people have saved, no. There's this need to spend actually. So probably that will be the bigger nudge next year.
Okay, so if status quo and inflation is arrested, and okay, we hopefully the war also ends. There's upside risk for growth, right? So hopefully that 8% does come to fruition. Question here, of course, we don't know the plans of the administration, but are you seeing them to be more expansionary, or stick to this fiscal discipline that we've seen in the last administration, and how might that impact our recovery story? Anyone?
Well,
Noel.
I'd like to think if they could be more expansionary, they would have done so. It's just that they're limited by the fact inflation is there. Yeah, so you just have to balance it off with that, because I think we already know that the focus really was to sustain growth. That will address a lot of things. So great jobs, reduce the debt to GDP ratio if your denominator grows because of GDP growth, right? So your debt levels come off. You expand wealth because you create jobs, and then the infrastructure spending still continuing, and then it's being complemented or supplemented by PPP, whereas the previous administration they halted on that one. So you now they're trying to keep infrastructure spending above 5% of GDP, which is going to be good. So that's also a source of growth for the economy.
Okay. Basil, are you seeing specific industries benefiting or blooming in this current administration compared to the past administrations? Or there's specific things that are really sticking out?
Well, it's still too early to say for certain, no, but definitely there's still, my sense is there's still push for infrastructure spending, as mentioned by Noel, 5% of GDP to sustain that the program from the previous administration. And I guess I would think that there could be a push towards more favorable policy towards the mining sector, no, especially given that we need all the revenues and the jobs we can get, no, given these difficult times, no. So I would say continuity of the previous policies, no, build infrastructure, and probably more favorable policies towards the mining sector.
Okay. Kaya na ba to say that we will outgrow our debt, our pandemic-induced debt, sooner rather than later? And do you concur with the Good Gov's statement that, compared naman to other countries, 60+% is not that bad?
Actually, that's true. If we compare with other countries, well, it's elevated now, but it was a necessity because of the pandemic. But to answer your question, if we're going to grow out of that depends on the growth levels that we have. Former DOF Secretary Carlos Dominguez was correct to say that we have to grow by 6% or greater than 6% in the next 6 years to be able to grow out of that. We validated those numbers with our own simulations, and it's spot on. We won't be able to grow out of that in the next 6 years. But as long as we're growing by 6% or greater than 6% in the next 6 years.
We're not eating into our economy.
Yes. So that will eventually support all the other factors that we have to get out of, chief of which will be the debt to GDP.
Okay, what did they wanted to say? Okay, which sectors you benefited? What market opportunities are you seeing here? You already mentioned, I think, banking sector for this low rate, but let's talk about the cyclicals. Is it that the time to shine already and to pick up the ones that have been really battered? Have they in any way already gone back to pre-pandemic? Because you mentioned, travel, transport, cars. Are you seeing that in the stock prices of the airlines, of the tourism, of even the car makers?
Definitely, given the recent market weakness, no, the improvement in the fundamentals are not reflected in stock prices, no. Just looking at, certain sectors like airlines or cars, transportation, they're far from their all-time highs or 52-week highs, no. This is because I guess certain sectors, as mentioned earlier, won't recover at the same time. No, airlines, you have high fuel prices, high jet fuel prices, which should hit their margins, even if air travel will definitely benefit with the pent up demand. For car manufacturers, they'll be hit by the weakness in the currency, So even if certain things are improving, it won't be across the board. All sectors benefiting. Some will be recovering faster. I mentioned earlier mining. Some coal manufacturers. Them that they're still given high commodity prices. They'll definitely benefit. I mentioned banks. They'll benefit. But in terms of the property space, mall operators will be good, but if you look at the residential or office, there could be some hit there with increasing vacancy rates and higher interest rates. Backouts from residential space have been increasing, but with higher interest rates, that there could be less demand for residential.
Okay, Dino, is there such a thing as looking at sectors when we invest in bonds?
Unfortunately, unlike equities, we're not really sexy. Equities are sexy in all ways, right? So we're a bit boring. As I mentioned, if we're a music genre, we'll probably be emo. So it's just really the tenor bucket. So right now we look at three tenor buckets in general in the Philippines. Like there's the 1 to 3 year, which is your short end, the 4 to 6 years, which is your belly, and the 7 to up to 20 years, which is the long end. We did make a call earlier that we actually prefer the long end. Again, bond traders like misery and pain, right? So, so they actually welcome the fact that our growth could slow down, and they welcome the fact that US could fall into recession. Because if you notice, the US 10-year, after hitting as high as 3.48% early on this year, it's actually trading below 3%. And if you look at the gap between the 2-year and the 10-year, it's actually the widest since 2000. That's a dot-com bubble, right? So it's a recession flag if you look at it all over the place. So the bond markets are actually pricing in the idea of a recession, and eventually the bonds will benefit from it, right? So I mentioned they actually love recession. They love the pandemic. So if you're a bond investor, you actually welcome that idea.
What about corporate bonds? Are there differentials in the ways that the different corporates are moving, or are they moving exactly in step with?
They're in step, and in fact, corporate bonds have been very very active as of late, and people actually invest in it. They've been offering very generous spreads versus that of the FXTN, the GS, around 50, 100. And investors, especially those who are a bit more moderate or conservative, who likes to sleep at night, right? I mean, they just want to get their coupon, sleep at night, and then worry about the market later on, right? So they actually prefer those instruments because at this point, you can see a lot of yield already. I mean, just to give you an idea, earlier there's a 4 or 5 month paper that traded at 3.25%. 2020, that's the 10-year paper. It's a 3%, right? So that's a lot of value right there already. Despite the fact that I think the short end has a lot of room to run in terms of moving higher.
But how would they, our audience here, select on which bond to pick? Which corporate bond versus do I just put it in treasury? Do I just put it in a T-bill? How would you advise them on how
Noel
to
can
play?
provide inputs on that. But for me, if you're gonna choose a corporate bond, I'd go for the longer dates. Like I mentioned, there's a corporate bond that's 8%, just recently issued, right? And inflation won't stay at, I mentioned, it won't stay at that level. If it falls to 3%, then you're holding an 8% paper, right? You just sit there and just enjoy your coupons.
I think corporate spread pricing is regionalized in the sectoralized rather, and within that sector, there's about credit quality. So the better ones are, of course, will have tighter spreads, and the not so better ones will be have a wider spread. That's I think how it's priced, though. But they're all based over the GS yields. So in that way, even if the GS yields move up, so in the same manner, their cost of funding also moves up, right? And the credit spread widens only if they think that the company's going to either find difficulties, no, in a high interest rate scenario. So that's how normally the market prices the corporates. Now, in terms of what allocating between T-bills, corporate bonds, GS,
Also, higher risk bonds, for example, lesser ranked bonds.
So it's a matter of looking at it two ways. No, one, of course, the investment appetite of the person. You have to evaluate your own investment appetite, and then from that investment, what's your need for your cash down the horizon in the future, right? So those two things have to matter when you decide. Because if you need cash, you cannot go long term. So you have to be there on the shorter end. Now, if you want yield with coupon payments, and you can go midstream in terms of tenor between 3 to 5 years. And if you want really capital gains, and you go long term, quite similar to equities, which is primarily long term on a view basis. No? Now, when you try and allocate your within the fixed income space, though, it depends now on how the view is versus how the market interest rates will proceed. So if in a rising interest rates scenario, that means if you're long duration, you stand to lose a lot in terms of losses or paper losses, right? So that means you try and shorten that a bit. Well, of course, you don't zero out your longer dated, because that's something that you have to sustain also. And then if now at the peak, let's say at the peak, we're reading the peak years, so that means now's the time to go longer duration in a way, right? But of course, we're all benchmark driven, so you can only go so much long so that you don't deviate too much from the benchmark returns.
Okay, thank you for that explanation, and also diversification and depends on your risk appetite. So you're not telling them to go risky or go safe. Okay, Basil, levels of the bourse or index at least, is there a support level now that we can see, especially after these moves?
Yeah. If you look at the market levels now, when we tested 6,000 last June 23, there was strong buying at that level, no, strong support at that level, and we bounced actually at 6,000. No? So we feel that 6,000 is a strong support. No, if we break that level, the next level of 5.7, and to the resistance levels are at 6.4 to 6.650. But I guess in order to break this sort of like medium-term downtrend, we have to really break that 50-day moving average, which is at around 6,500 now. So if you break that 6,500, next level will be at the 200-day moving average at around the 7,000 level now. So we feel that markets could be range bound for now. I'm waiting for next.
Where are the risks tilted, Basil? Is it in the 5.7? Is it in the 7,000?
Tough to say, no, but I would just highlight some seasonal trends now. So we're approaching the ghost month. August is the ghost month. Okay. So seasonally, that's a peak period for the market. But this is if the market dips during the ghost month, that is a buying opportunity, because if you look at fourth quarter, especially December to Feb, that's a seasonally strong period for the market. Historically, that's the best 3-month period for the market. So we foresee a year-end rally, especially if you see a less hawkish Fed. Our year-end target is at 7.2 to 7.5.
With a less hawkish Fed. Okay, very interesting point here. Go.
Where we are now, for example, 6,250.
Yeah.
Even just we reach 7,000, it's already 12%.
That's a lot. Yeah.
Ready, right? So that's why I think if you look back during post-crisis periods, it's always the contrarian that buys during those times that really are able to enjoy the returns, no, once the market recovers. In the same way, at 8% during 2018 on bond yields, and they recovered 2019, 2010, the fixed income market also enjoyed double-digit returns. So, which is why we are actually headed for a period or a state where both equities and fixed income will be able to provide good returns.
How are we doing compared to other markets? Because in the pandemic, the U.S. markets were just off the charts, and they're saying that we just basically caught up, diba? And we haven't even really caught up. I mean, tell us how have the markets come back to earth elsewhere offshore, and are we actually doing better when it comes to, I don't know, PE ratios or links to fundamentals and how we're trading compared with other markets in the ASEAN or offshore?
Basil actually has the slide over there if you want to show that. It's
So from a relative standpoint, we're doing better. But if we look at regionally, the Philippines versus regionally, the Philippines versus the region, we're one of the worst performers. Our peers are doing better. I guess this is mainly driven by the sentiment on the currency or the macro environment, the view that we're in a current account deficit, the peso weakening, and the inflation levels are quite high. That's leading to the markets selling off. But if you look at from a valuation standpoint, markets are really cheap. We are trading at around 15.5 times PE, forward PE, versus the 10-year average of around 18 and a half. So we're one standard deviation below the 10-year average. And even from a price to book basis, we're at 1.5 times price to book versus the historical average of around 2.2. No, so that's also one standard deviation below the 10-year average. So markets are really cheap. And I mentioned earlier that we foresee the earnings EPS will already surpass pre-pandemic levels, but as early as next year. No, so if you look at where we were during the pre-pandemic levels, we're at 7.475. No, so at the very least, we think that that should be a conservative level that we should be able to achieve now if we reach earnings surpassing pre-pandemic levels.
Basil, should we be, because you mentioned specific sectors, right? Should we be, like you mentioned, if you enter the index and if you just trade the index, chances are it's going to go up. It's just a matter of time if you look at the PE ratios. But if you enter specific sectors, we're not too sure. So is the strategy now, blue chips, general economic fundamentals, or selectivity?
Yeah, so our focus will be on blue. So our focus will definitely be on, if you look at the foreign selling, the Philippines has witnessed foreign selling for multiple years already. So if you look at the foreign ownership levels, we're at decades low already. So if you look at the valuations for big cap names, looking at the table here, a lot of them are trading below the 10-year PEs, whether price PEs for corporates, and price to book for banks. A lot of them are trading really cheap. 25 out of the 30 index issues are trading significantly below. And given that if we think that the markets will rally in the fourth quarter, the first issues that will go up in value will be the liquid big cap names, because that will be the focus of foreign investors now, because those are the names that are easy, to go in and out. The liquidity is a priority for foreign funds. So we would be focusing our investments towards these cheap liquid blue chip stocks.
Okay, very clear answer there. All right, gentlemen, I think we're nearing the end. Just one last question for our audience here. I've been trying to think of which one would be the best. Okay, what is the best way to hedge against inflation this year? Right.
Well, yeah, can I
Go
answer
ahead,
first? Yeah.
please.
Well, actually, inflation is like right now, like Thanos with all the Infinity Stones. It's practically unbeatable at this point, right? I mean, but in the end game, you can actually beat him. Like it's just simple. I guess I mentioned it's for fixed income, it's quite simple, right? It's like taking a one step back, two steps forward approach. I mean, if you buy a bond now, definitely you're losing on in terms of capital gain. I mean, capital gains, and of course, um, positive carry versus inflation, right? But it won't stay for long, right? Yeah, that's what I mentioned. Eventually down the end game, you will beat inflation, especially if you time it correctly and if you time it properly. Um, I hope my old boss is watching. He gave me a quote before when I was starting 2003. He said, "Buy at a level you don't want to sell, and sell at a level you don't want to buy." Like for at 7% on a 10-year, you don't want to sell that, right? To buy that's a buy. And if it does go higher, even if it does go higher, I'll still buy more because definitely you won't sell a paper at 7%. So yeah, that's one way to beat it, but not now.
All right. Yes, Noel.
Okay.
If we
Hello,
have
hello.
cash and we need to put it somewhere to beat inflation just so that our cash is not losing money every day,
Well,
what can we do?
Well, initially we said fixed income markets is about to reach its high peak and rally. In fact, we may have already seen a semblance of that because the 10 years has already started rallying from 7.25 was the high. 7.25% was the recent high in terms of the auction. So it's now at 6.6. So that they've kind of already showed that there's potential there. And if you are able to buy at 7%, then you are already hedged primarily on inflation, even if we had 6.1% recently, right? So that's something to look after on the short term. Now, of course, it's always been maybe a broken record, but for long-term basis, that's where you, again, get your kicker from being in equities. So now, when investing, of course, money that you do not need, you can invest in equities. Money that you may need in the short term, you should put in fixed income.
Okay, very clear. Yes, Basil.
Definitely, I'm biased, no. So,
Equities.
yeah. So I think if you definitely it depends on the person. No? If you have a long time horizon, no. I mean, Warren Buffett always said, no. You have to be greedy when others are fearful and fearful when others are greedy. And this is time to be greedy. Markets are really cheap now. I don't know if you can feature the slide here, but what gives me confidence and to be able to sleep soundly at night now and I think and I always say to myself, this too shall pass. At the end of the day, if you look at the fundamentals for the Philippine economy, it's really solid now. We're on solid ground. We have strong OFW remittances, strong BPOs. We have young and dynamic workforce. We're in a demographic dividend sweet spot from 2015 to 2055. So that will result in high GDP growth for years to come. Um, so that gives me the ability to sleep soundly at night. And you have to have a long time horizon. Yes, admittedly, we don't know where the bottom is, but um, every time markets dip, that is time to average peso cost average. Start adding to your investment, and 5-10 years down the road, you'll be happy that you're buying at current levels.
Thanks for that. So invest in the economy, no matter how dire it is at the moment. The fundamentals are strong. Dan, any concluding remarks?
I'll have to agree with what Noel said, no? And I'll add on to that at the pain of, at the risk of inciting a war between my friends here. Well, you have to be able to invest in the long term talaga. I think because inflation can go both ways. It could actually go up, no, or eventually stabilize. No? But we have to look for that portfolio, those range of products, those range of asset classes that will give us the edge to actually either benefit from the inflation that we have right now, like what Dino said, or beat it, no, like what Basil was mentioning earlier. No, so I think it's the ability to distinguish that equity in portfolios that you want, no, to be able to beat inflation in the long run. No? So that's why we have these guys actually to help us do that.
Very well. Yes, Noel.
Their sleepless nights with us. We're the ones who have sleepless nights now.
There you have it. Thank you so much for that. Now, before we let you go, just to give our audience an idea of what Security Bank is offering. So we discussed the high interest rate environment. Security Bank is recommending to invest in fixed income instruments. I think this was very clearly mentioned as well by Dino, particularly on corporate primary issuances. Okay, so Security Bank Corporation itself will be issuing 1.5-year fixed rate corporate bonds. That's at 3.7407% gross per annum, booked through SBC TAMG's directed investment management account. Now, there are also other corporate issuances in the pipeline. You've got indicative rates of 5.59% to 5.9% for 3 years. And then for the 5-year tenor, you've got 6.46% to 6.9%. Now, if you are new to investments and you prefer to have seasoned fund managers, as we have had here on the show, of course, invest your money for you. We recommend investing in unit investment trust funds. So you can see that on your screens, UITFs. This would allow you to diversify your investments for a minimum participation amount of only 10,000 pesos. So a very good way to just dip your feet into investing there. Now, for fixed income naman, you can invest in SBC TAMG's money market fund. So this aims to achieve short-term growth by investing in bank and government deposits and all other instruments that, of course, the Bangko Sentral may allow. Now, this SB is a peso fund, and it aims to achieve long-term growth by diversifying. That's mainly into medium until long-term fixed income securities. So, and again, another tenor that we are clearly watching out for. Now, for investments in equities naman, if you're interested in what Basil had to say, of course, TAMG has 3 peso equity funds. We've got the SB Philippine Equity Index Fund, the SB High Dividend Peso Equity Fund, and the Peso Equity Fund. Now, a common question that potential investors and, of course, our viewers here ask is how to time the market. And I think this was answered also earlier on. The answer is time in the market, not timing in the market. Invest long term if you really believe in the fundamentals of the economy. We also recommend cost averaging and investing regularly. So you've got SBC TAMG that offers a regular subscription plan for the UITFs, which you see on your screen right here, where your account will be automatically debited for investment once or twice a month, depending on your preference. So very interesting. You could actually have a subscription plan that will do it for you. And in addition to the fixed income securities and UITFs, SBC TAMG also offers the following products and services. You could see that on your screen. So if you are interested, there you have it. So take a few seconds to check that out. So we've got also the living trust, escrows, facility, security, and collateral agencies, and of course the feeder funds. But more information, of course, just get in touch with us. That is through this email, trustmarketing@securitybank.com.ph, and a trust sales officer will be very happy to assist you. You can see your trust officers on the screen here. Are beautiful ladies, actually, a lot of them. Okay, so for those of you that have questions, it's a shame we aren't able to take audience questions here, but we will make sure to answer that. So get in touch with us right after the event, and we'll try our best to answer that offline. All right. And at this point, I'd like to thank our speakers, of course, Dan, Dino, Noel, and of course, Basil, for this very insightful discussion. It's been a great 1.5. I don't know if great is the answer, but at least I've gained quite a lot of insights, and that is the best thing we can do at this point. No, focus on the things you can control, get more education in our head, be more aware, and of course, listen to the experts. So thank you so much. And before we log off, please take a moment to scan the QR code on your screen. This is a post-event survey. We want to know what you thought of this discussion and what you would like us to do to make these events even better. And on behalf of Security Bank, I would like to thank all of you guys for tuning in. It has been a pleasure. I'm Danny Laurel, and stay safe, everyone. Thank you, gentlemen.
Bye.